Welcome back. I'm going to take a look at a concept a little bit different than what we normally talk about. Today we're going to talk about the convergence, divergence of different stock indexes. The four most common stock indices that we talk about are the Dow Jones Industrial Average, S&P 500, the NASDAQ, and the Russell 2000. Now the Dow Jones Industrial Average are the 30 largest listed companies that represents the U.S. economy. It includes names like American Express, Boeing, Home Depot, Coca-Cola, Walmart. You have the S&P 500, which is comprised of 500 companies with the largest market capitalizations in the U.S. The NASDAQ is a little over 2,500 stocks, and it's heavily weighted towards technology, healthcare, biotech, those type of industries. And then you have the Russell 2000, which are 2,000 stocks of the smallest market capitalization. And they're comprised of various sectors weighted especially towards technology and biotech. Now, each index is ranked based on its daily closing price in relation to its rolling 1-year trading range. So, for example, if you have a stock with a trading range of $1 to $100 a share, when it hits $100 a share, that day it'll have a ranking of 1, meaning it's the first place within the year's ranking, within the year's trading range. If it goes down to $1 a share, the 52-week low, it'll have a ranking of 365, meaning the lowest ranking for the entire year. Now we're also going to consider the spread between the different indices to see if they're all trading together or separately. Usually when the market has some sort of consensus, all the indices will trade together. When we're about to see a big move in, either to the upside or downside, one index may break out or break down before the others. So we're taking a look here. This is the year 2000. The purple line on the top represents the S&P 500. The blue line is the Dow Jones Industrial Average. The red line is a Russell 2000, and the black line is the NASDAQ. Notice towards the latter part of the year 2000, when the stock market really initially started to go down, the black line, which represents the NASDAQ, moved down before the blue, the red, or the purple lines. And if you recall, the stock market crash in 2000, 2001 was primarily a dot-com crash. It was led by technology stocks moving lower. So the black line, which again represents the NASDAQ, which is heavily weighted towards technology, biotech, those type of sectors, that index moved down first. That was also followed, by the way, by the red line, which is a Russell 2000, which represents the small stocks that are also heavily weighted towards technology. Now notice over here, this is 2000, 2001. The blue line is the Dow Jones Industrial Average. The black histogram bars over here show the spread. When these black histogram bars go up, it means there's a wider range, more of a divergence between the different indexes. So between the Dow, the S&P 500, the Russell, and the NASDAQ, when they're all trading together in unison, this black histogram bar is very low. We can see when the Dow Jones Industrial Average, especially in the year 2001, when it really went down a lot, it was preceded by this histogram bar spiking up. If you recall, again, in the year 2000, it was the NASDAQ market that moved first. This black histogram bar forecasted, to an extent, that the market was going to go down because the NASDAQ broke down before the other ones did. And we see that. We don't know which index in this case went down, but we see the indices started to break apart from each other. And that was led, obviously, by the NASDAQ going down. And that's where we see the histogram bars going up. In addition, when the Dow Jones Industrial Average hit that very, very big low in September of 2001, the histogram bars hit a low. They went down a lot. That shows us that all the indices went down together. There was a consensus. All stocks went down. When the market then continued to proceed with its crash lower in the latter part of 01 and 2002, again, this spread increased again because one index moved ahead of the others. Not all stocks move at the same time, depending on the condition, the reason why the stock market's going down. So when that spread moves up, it means that one index is moving away from the others, and that could indicate that we're at the beginning of a breakout or breakdown. 2008, we take a look at 2007, actually, October '07, we see all the indices are near the high, but the black line, the Russell 2000, moved down first. It broke down a lot, followed by the S&P 500. Notice the green line was the last index to move down. The green line's in NASDAQ. If you remember the reason why the stock market crashed in '08, in part, it was the housing market crash. Well, the NASDAQ has the least to do with housing. Really, it's a Dow Jones Industrial Average. I would say also the S&P 500, and also as a general broad-based market sell-off, which really hurt the small companies. Usually small companies do very well in a strong economy and very poorly in a weak economy. So in this case, a Russell 2000 was the first index to break down. And we take a look at 2008 over here. The blue line again is the Dow Jones Industrial Average, just to show us, generally speaking, how the market moved. And we see 2007, we're chugging along really nicely near the highs. All of a sudden, in late '07, we see this spread, the black histogram bars pop up. And that shows us that one of the indices, in this case, the Russell 2000, started to break down. It showed us that trend was changing. And what was doing well for the Dow Jones stocks and the S&P 500 stocks was not doing so well for the Russell 2000. And then we hit the bottom over here in 2009, March 2009. This black histogram bars are very, very low. And that shows us that all the stocks hit a bottom together, that there was a consensus, that all the stocks went down at the same time, affecting all the different indices. Then we started to mount our recovery. And again, when the market starts to recover, when the economy starts to recover, it does not affect all stocks equally. So certain stocks went up before the other ones did. Fast forward to 2019, we see actually late 2018, all the indices are trading right near their highs. The yellow line, the Russell 2000, breaks down first. That was followed by the purple line, the NASDAQ, the orange line, the S&P 500, and finally trailing the Dow Jones Industrial Average. Now, 2018, 2019, that crash was, due to the COVID crisis. It's a little bit of an unusual situation in the sense it was a very rapid sell-off that came right after a very strong period of economic conditions. But we can see that the Russell 2000 went down first. Usually the small cap stocks get hurt to a much greater extent than the larger cap stocks. Now, in terms of the spread, 2019, we see that the market was near its highs in the end of 2018. All of a sudden, again, as a Russell 2000 started to break down first, this spread starts to widen, and then the other indices, of course, followed. We hit a consensus late 2018, 2019. That's when we hit that low, and then all the stocks hit the low at the same time. And that showed us that traders and investors were just selling everything. And eventually when the market started to recover, all the stocks went up, but then the indices started to separate again as some companies do better than others. Fast forward to present day, we can look back to April, May. This is actually starting the beginning of 2022, when the market experienced quite a bit of fluctuation between strong and weak trends. 2022 was a very choppy year, to say the least. In April, May, all the stocks hit their respective lows, and it really was a consensus as all the stocks moved together. The black histogram bars show us the spread between those two. Now, the red line is the Dow Jones Industrial Average, orange is S&P 500, the white line is the NASDAQ, and the yellow line is a Russell. Now, fast forward to October 2022, the stock market started to go back up, but it really was led by the Dow Jones Industrial Average. Again, that's the 30 largest stocks that represent the U.S. economy. Caterpillar, Boeing, Home Depot, things like that. Notice the white line, the NASDAQ has really been lagging. Those stocks like Tesla and maybe Microsoft, things of that nature, have not been doing well. Also Facebook and other technology-related stocks, they have been lagging. We would have been much better off to stay in Dow Jones Industrial Average stocks like Caterpillar and Boeing as opposed to Tesla and the other technology stocks, because those really have been lagging. If and when we hit some sort of very big high and maybe a point of a reversal, I would anticipate that would occur with some sort of consensus where all the stocks are moving together and the histogram bars hit a low again, where it indicates that all the stocks are moving in the same direction. Usually when all the stocks move in the same direction, it means there's a very strong trend, but it also oftentimes could indicate that we're close to a turning point, because once all the stocks go up, then there's nowhere to go but to the downside. We're going to continue to monitor these charts very closely over the time to come, and we'll be certain to update with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.